Now, Bangladesh is set to get $1.5 billion from the World Bank this month. The World Bank board is expected to clear 3 loan programs for budget support. The Strait of Hormuz crisis triggered by the Israel-Iran conflict sent oil prices past $114 a barrel earlier this year. Bangladesh imports 95% of oil and LNG. Finance Minister Amir Khosru Mahmood Chaudhry says that the war has added nearly $3 billion to the country's energy import bill between March and June alone. Now, that's a direct hit on foreign exchange reserves, which were already running thin. Bangladesh's tax to GDP ratio is one of the lowest among middle-income countries, around 8.5%. Revenue collection keeps missing targets. The International Monetary Fund withheld its 6th tranche of a $5.5 billion program in December, waiting for an elected government. The BNP won the February election, but the money still has not arrived. While reforms on exchange rate flexibility and banking sector cleanup remain unfinished business. And this is where the World Bank financing matters strategically, not just financially. The $1.5 billion is split across 3 tracks: institutional governance reforms, financial sector stability, and energy security support tied to LNG imports. Crucially, around $800 million of the aid is repurposed money from stalled old projects, not fresh debt. That's Dhaka squeezing liquidity out of its existing World Bank pipeline rather than borrowing more. Multilateral lenders usually coordinate. World Bank, ADB, AIIB, and Japan typically wait for IMF's blessing before releasing budget support. An active IMF program is the seal of approval that unlocks everyone else. Bangladesh is essentially racing to show enough reform progress to keep that pipeline open, while a new government just months old inherits both a war shock and a banking crisis. It didn't create. Investors will watch whether banking reform conditions, especially around the Islamic Bank mergers, actually get implemented or get diluted under political pressure.